welcome to the 13th Annual Pershing Square Challenge. My name is Meredith Trevetti, and I'm the Managing Director of the Halbron Center for Graham and Dodd Investing. While it's certainly unfortunate that given the current circumstances, we're unable to host this event in person, the silver lining of this online platform is that it gives us the opportunity to broadcast the work of our students. Thank you to Professor Anna Ruth Dougal and Michael Herman for getting us to this point in the semester and teaching the Applied Security Analysis class. Thank you to Caroline Reichert and Julia Kimiagarv on my team, who planned not only the in-person event that had to be canceled, but tonight's virtual experience, as well as handling all of the logistics related to the class throughout the semester. And finally, most importantly, thank you to Bill Ackman, whose generosity has allowed this class and event to take place at Columbia Business School for now 13 years. When I talk to students about their experience at the school, many say that the highlight of their academic career was the Pershing Square Challenge. Bill, we are truly grateful for your continued support and generosity. And with that, I'll turn it over to Professor Dougal.
Thank you, Meredith, and thank you all the participants for joining today's webcast for the 13th Annual Pershing Square Challenge. I hope you and your families are staying safe in the current environment. This is the second year I have taught Applied Securities Analysis, or ASA, and the first year I've taught it with my co-professor, Michael Herman. ASA consists primarily of first-year MBA students, and the aim of the course is to provide students with a foundation for investing in the public markets. Over the course of the semester, the students develop a stock pitch in teams of 3, and we had 23 teams this year. Pershing Square chooses 5 of the pitches to compete in the final case competition, which you will be witnessing today. The 5 stocks being pitched in alphabetical order are Ball Corporation, Broadridge Financial, EPAM Systems, Sysco Corporation, and Veris Analytics. The format for tonight will entail a 10-minute presentation from each team, followed by 10 minutes of Q&A from the judges. At the conclusion of the presentations, the judges will meet for a short deliberation, after which the winner will be announced. Congratulations again to the 5 teams for making the finals, and good luck tonight. I wanted to take this opportunity to thank a few people as well. First, Tano, Meredith, Caroline, and Julia from the Halbron Center. Not only were they instrumental in putting together the first virtual Pershing Square Challenge tonight, they also helped ensure a seamless transition of the class to an online format mid-semester. Michael Herman, who joined me in teaching ASA this year and deserves a lot of the credit for the quality of the pitches you will see today. All the funds and mentors who helped the students develop their pitches, the TAs, David Howe and Mark Hoop, for their assistance throughout the semester, the judges for taking the time to be here today, thank you again. And finally, but most importantly, the students. While we can only have 5 teams up here today, there was a tremendous effort put into all 23 pitches. The quality of the pitches was excellent, and you should all be very proud of yourselves. That being said, the COVID-19 lockdown may also deserve some credit. As one student said to me, there was not much to do during the lockdown, so I spent a lot more time on my pitch. Hence, in the spirit of continuous improvement, I've been told that CBS is now considering an annual 2-week lockdown prior to the competition to maximize the quality of the pitches. Joking aside, it's been a pleasure getting to know all of you, and Michael and I hope to see many of you back on campus next year. It really was an unexpected semester, with the second half of the course moving fully online due to the lockdown. We had students joining class from all around the world, some from their home countries such as India, and some from spring break locations where they got stuck. As an example, one of our finalists had the highly unfortunate circumstance of being stranded in Hawaii, where he was on vacation. He didn't pack a dress shirt for his trip, as it was before the finalists were announced. So with all the stores being shut and Amazon Prime not considering dress shirts shipped to Hawaii as an essential service, don't be surprised if he shows up in beach attire tonight. As our class knows, we like to include a few investing lessons and life lessons that we have picked up over the years as part of each class. Given this is technically the last class of the semester, we would like to continue with that tradition and leave a couple of parting thoughts. They say experience is one of the best teachers in life, and over the semester, the markets have taught the students one of Ben Graham's most important lessons about Mr. Market. Graham famously described Mr. Market as temperamental, with bouts of boundless optimism and bottomless pessimism. The students all got a taste of this over the past 2 months. Between their highs in February, when they picked their stocks, to the lows in March, the average stock pitched by the students declined over 40%. Over the subsequent month, the average stock rebounded over 50%. It is clear that the long-term value of these businesses didn't decline 40% in a month and then suddenly increase 50% the next month. This highlights Graham's lesson in distinguishing between price and value when he wrote, "Price fluctuations have only one significant meaning for the true investor. an opportunity to buy wisely when prices fall sharply and sell wisely when they rise a great deal. The markets taught this lesson better than we ever could in class. And I would like to leave you with a final piece of advice from Warren Buffett that Bill had referred to in his talk to the class, which is, if you want to increase the chance of success, look for qualities you most admire in your fellow classmates and adopt them. I have gotten to know all of you, and it is clear to me that there's a lot of unique and admirable qualities that you possess, and I hope you strive to learn these from each other. On that note, I would like to introduce our sponsor, Pershing Square. Bill Ackman and his fund have been generous sponsors of the Pershing Square Challenge, with this being the 13th year of the competition. On behalf of Columbia Business School and the Helbert Center, I would like to thank Bill and Pershing Square for their support, time, and mentorship to the program. Bill, I know you were not able to join last year, but for a very good reason, as you and your wife were welcoming your baby daughter into the world. Congratulations again to both of you. We're glad to have you back this year. And I'd like to turn it over to you to say a few words. Thank you.
Well, thank you so much. I look forward to this contest every year. It's amazing. It's been 13 years, a lot of life change over that period. Rika, the baby that interfered with my participation last year, is turning 1, this Saturday. So, if you've tracked her compound growth since inception, it's something that every value investor would aspire to. I want to thank, of course, Meredith for really captaining the ship, and the rest of the Columbia team, and the Professor Dougal, Professor Herman. These are effectively the return on their earnings you receive from Columbia for taking on this responsibility. I know is enormously high because of the psychic value you receive, from doing this, and without your, stewardship and teaching the students, I think a lot of education wouldn't be happening. Now, I always have to question why I did this in the first place. Number one, I didn't go to Columbia Business School. Number two, what incentive does an investor have to train the next generation of investors to be better, because they're going to enter the workforce and they're going to compete with us, and we're still at it. But I'll have to say that on the Columbia part, I think Columbia really has the best investing program, coming out of the Warren Buffett rejection from Harvard Business School way back when, one of the worst rejections in Harvard Business School history, and to really the value investing program that's developed over the years. And I feel great about the fact that this class has become, an important part of the program. So we're happy to be a sponsor. So without further ado, the last thing I'll say is, the investment business is one of the great businesses of the world. And if you're successful in this business, you will be amply rewarded financially and otherwise. You just look at the alums, on the judging list and their successes over time. And so when you have more than you need, I think you're obligated to give back to society. And one of the things we hope to teach a bit about in this class is philanthropy. And the way we teach that is we grant the prize. We've done 1, 2, and kind of a grand prize and a second prize. We've done a first, second, and a third prize. But the prize winners receive the entire $150,000 prize. And then they have the right to keep it all, give it all away, or split it with Columbia. And you can't learn about philanthropy unless you suffer the economic costs of giving and the rewards, the psychic rewards of receiving back. So we hope to teach a bit of that, or give you a taste of it as part of the program. Let me allow the judges to introduce themselves. And what we tried to do this year is have a terrific kind of broad spectrum of investors, both from a generational point of view, from a educational point of view. We have a number of Columbia greats featured today, but we'll introduce them in order. And Lee Cooperman, please tell us a little bit about yourself, and in that you are I'm sure I'll love a little tiny anecdote about what it was like way back when, the class of '67 at Columbia Business School, and what you learned and how it led to your success.
Well, I would say that, I graduated Columbia January 31st of 1967. I had a 6-month-old child, had no money in the bank, and I had a student loan I used for my tuition. So if you read a balance sheet, I was broke. And the very next day, February 1st of '67, I went to work at Goldman Sachs, and I lasted there for close to 25 years. I retired from Goldman at the end of '91 to start a hedge fund. I ran that successfully for 26 years. And basically, I became a family office effective January 1 of 2019. And Columbia did a lot for me. I'm a kid out of the South Bronx. I went to public school in the South Bronx, high school in the South Bronx, college in the West Bronx. I never would have got into Goldman out of Hunter College, where I got my undergraduate degree. So Columbia opened the door to Goldman. I learned the language of business at Hunter. I got an MBA, so initials after my name. And most importantly, I met some great lifelong friends. One of my closest friends is on the panel tonight, Mario Gabelli. He was from the Tony part of the Bronx. I was from the tough section of the Bronx. But, you know, it's worked out very well for me. And I would say that I feel a debt of gratitude to Columbia, but they've collected, you know, it's not like Steve Schwartzman, who gave some money to a Yale, but you know, I think I've given about 40 million to Columbia, and happy, and hopefully they'd use it intelligently. And that's it, you know. I agree with your comment about philanthropy. I think you as well have taken the giving pledge with Buffett, and I intend to give all my money away back to society. I live a very modest life, and I've been very blessed. Right now, I'm luckily sitting in Boca Raton, Florida, heading back to New York on May 28th. Is that enough?
That's a great introduction, Lee. We're going to, Mario apparently is still having technical difficulties, so he's still learning how to use a computer. But we're going to go to Dahlia Loeb. Dahlia, tell us a little bit about your career and what you're up to.
Hey, everyone. Let's see, I can't see myself. Can anybody else see me?
Yes, we can. Go ahead.
Okay, all good. Terrific. So I'm Dahlia Loeb. I'm a managing director at Arcadia Investment Partners. We are a $2 billion multifamily office. We invest across public and private equities and credit. I've been with Arcadia for about 5 years. I spent my career before that in the hedge fund industry, which was about, goodness, a 16-year period. I have tremendous respect for the Columbia Business School program in value investing, in particular, what Bill is doing in terms of the Pershing Square Challenge. I share Bill's alma mater on both an undergraduate and a graduate basis, and certainly from the MBA perspective, there were many phenomenal things about it, but they didn't have anything like this.
Thank you so much, Dahlia. Thanks for participating. Anthony is from Pershing Square. Anthony, why don't you give a brief introduction?
Sure. Hi, Anthony Massaro from Pershing Square. I am also originally from the Bronx, Pelham Bay, just for the first 5 years of my life, and then grew up in Westchester County, just north of there. I went to the Wharton School for undergraduate business. Studied a lot of, took a lot of similar courses to the one that you're that we're presenting as part of now. After Wharton, I spent 2 years at Goldman Sachs, and then 2 years in their investment banking division, and then 2 years at Apollo's private equity group, before I joined Pershing Square in the summer of 2013. So I've been there almost 7 years, and it's been an incredibly rewarding experience. I've seen, a range of different investments and market environments, and you learn something new every day. So looking forward to seeing the pitches.
Great. Thank you, Anthony. Jillian, please.
Sure. Great. Thank you. Thanks, Bill. Thanks for having me back again. Really enjoy the event. So I'm Jillian McIntyre. I'm a partner at Appian Way Asset Management, and I partnered with Drew Byington to launch Appian Way in December of last year. We're backed by Morgan Stanley. We're a long-short hedge fund. We focus on industrial and cyclical companies. My background, I was originally at Morgan Stanley as a research analyst, and then I moved into hedge funds in 2005. I worked for Art Sandberg at Pequot and then Sir Chris Hahn of the Children's Fund. I'd just like to give a shout out to the team, because we've been working separately like everyone else for a few months now. So to Drew, obviously my partner, Sam Dubinsky, Kevin Korb, our COO, Desi DiPiero, and Caroline Gorlick. Okay, that's right.
Thank you so much, Jillian. Anna, also a Columbia Business School graduate, tell us a little bit about both your Columbia experience and then what you're up to.
So before Columbia, I was actually an analyst for 9 months for Mario Gabelli, which was invaluable. I read about him in the New York Times, and I read that he liked to hire Columbia Business School students, and I had been deferred. So I cold called Mario Gabelli, and I said, hi, can I come work for you for 9 months until I start the January program? He was very kind. So I did the reverse commute from New York. And then I went to Columbia, where I studied with Pat Duff, who was the junk analyst at Tiger at the time, who taught me how to model and taught me not to ever use sell-side research. That was the one way you would be guaranteed to fail a class. And after Columbia, I went to Goldman Sachs to asset management for large cap and mid cap, where I pretty much was a generalist. And after a couple of years there, in 2000, when a lot of my tech companies were turning, I decided to go to the dark side and short them. And I went work for Zweig Domena. Marty was still there, and Joe, and a couple of really good people that specialized in shorting taught me how to short. And then I started my own thing. So I do long short, global, fundamentally driven. We do a lot of cyclicals. We do some consumer, but in the last 10 years, we've really been focused on cyclicals overall, because I started as an auto analyst.
So Anna, isn't Axel Capital Management the name of the firm in billions?
He stole it. He stole it. It's terrible. He got rid of the L. I didn't patent. I only patented Axel, so it's terrible. I need to call him up and tell him this.
Okay, good. John Paulson of Paulson and Company.
Yes, hello everyone. Thanks again for having me as a judge, Bill. I think I was a judge once or twice before. Had an opportunity to review the presentations before, so I think you're all doing great work. As for myself, I'm from New York. I went to NYU undergraduate and then to Harvard Business School. I started in Wall Street in 1980 in mergers and acquisitions at Bear Stearns. And after 8 years in becoming a partner, I switched to the investment side, became a partner at a risk arbitrage firm called Gruss & Co. We specialized in merger arbitrage, bankruptcy reorganizations, and other types of event arbitrage. In '94, I formed Paulson & Co. And been running that firm for the last 25 years. Today, primarily manage my own money. We still have some outside capital, but it's gotten smaller over time. And but we remain active in those 3 core areas.
Okay, great. Thank you, John. Don't forget to mute your line. I noticed Mario has crossed the technological Rubicon and appears with his name on the call. But Mario, if you click on the video, we might actually be able to see you, which we'd love to do. And then if you could click on the mute button so that now we can hear you, and you can give a brief introduction about who you are. I still can't see you, but maybe that's a choice you're making.
Yeah, that's a good idea, Bill.
Bill, scroll over. He's on the phone and the camera, but he's on.
You've got me now?
Yeah, we can see you.
Go ahead, Mario. You're on.
Terrific. Well, I followed Lee. He lived in a less glamorous neighborhood. That's a BS. Then in addition to that, we have Anthony was also in a different neighborhood. I went to Columbia and I knew I wanted to be in the investment business. And from my point of view, it's fairly uncomplicated. The sun, the moon, and the stars all aligned when I took Roger Murray's class on security analysis. So I'm delighted to be here. And I know most of your fellow panelists look forward to the 5 participants and presentations.
Okay, thank you, Mario. So I think we're going to jump right in. Meredith, you want to line up the first presenter? And Mario, just so you know the format, everyone gets 10 minutes. I'll time it.
I was listening to you all along. Thank you, and thank you for all you're doing, and everyone else.
Okay, perfect. So Meredith, the first panelist, Ball Corporation.
Yep.
You guys get started.
Great.
Okay. Good evening. My name is Leticia Pataji. My teammates Lou He and Rafael Matos and I are here to present a long pitch on Ball Corporation. Ball is mainly known as a leading manufacturer of beverage cans. Because of the ever-increasing concerns about how certain beverage containers negatively impact our environment, coupled with more than 15% price decline as investors ignore the resilience of this business during market downturn, we believe that this is the perfect time to invest in a great business with a long runway. Our pitch is predicated on 3 theses. 1, an attractive beverage can industry outlook. 2, Ball's ability to grow above the industry volume. And 3, the high growth potential of the aluminum cup and aerospace business. Our 2024 price target is $115, giving us 76% upside in the base case. Ball Corporation is a $23 billion market cap company that has 2 major businesses, the aluminum beverage can and the aerospace service, and is looking to build out a 3rd business, which would be the aluminum cup. Its global market share is 32%, and as of 2019, the aluminum can business accounted for 87% of revenue, while the aerospace accounted for 13%. On a valuation perspective, in our base case, Ball will generate a 15% 4-year IRR. On top of our thesis, Ball has a competitive moat that would help it maintain high return and grow its market share. This moat comes from 3 things. 1, it is its customer relationship. It takes time to secure a contract, and on average, contract usually lasts 4 years, and the majority of them are renewed. Additionally, can makers have to secure a contract before they even start building or even expand their facilities. The second thing is its operating expertise coupled with extensive investment in R&D that has resulted in numerous patents. And lastly, it is the scale and reach to cover a large footprint to serve its customers.
So our investment thesis is threefold. First of all, we believe overall, the beverage can industry will grow at least 4% CAGR in the next 5 years, outpacing historical growth in 25+ years. The 2018 inflection point reflects beverage makers' increasing commitment to sustainability and product proliferation. We think those 2 themes will carry on in the future. So first, we noticed that both end consumers and customers are increasingly aware of aluminum's infinite recyclability and high economic value compared to other substrates. In fact, aluminum is the only substrate that can subsidize both plastic and glass in all municipal recycling programs. Since Coca-Cola released its first global sustainability report in 2018, we expect more CPG firms to follow suit. Second, we see that product proliferation led by beer category will nurture can growth because of increasing demand for more local and more premium craft beer, which is mostly in can packaging. On the other hand, we also see the increasing popularity of spiked seltzer and canned wine will further catalyze can adoption in the future. Furthermore, we believe structure shift is being shaped by ongoing regulations happening across the globe. In the US, we see San Francisco has already banned single-use plastic bottle in San Francisco International Airport's city-sponsored newsstands and food vendors. We think this trend will continue in the future, which will further benefit beverage can growth. Our second investment thesis is Ball will outgrow industry average in terms of volume. So we see that for the future 2 years of all the capacity expansion plans that have been announced, Ball is able to capture over 80% market share. We think this momentum will continue in the future for 3 main reasons. First of all, we think Ball's market leadership is driven by its overwhelming strength in specialty cans. So specialty cans is all non-standard 12-ounce cans. The biggest advantage for a specialty can is higher price. So as you can see, Coca-Cola's 16-ounce can is priced almost triple compared to standard 12-ounce. And we also see other beverage categories such as canned water has also started to embrace different can sizes. So in the past decade, North American specialty can penetration has almost doubled. And we also see that Ball's specialty can SKU has outgrown its peers. We think the growth of specialty can is driven by both consumers' preference and the need to differentiate different products. On top of that, we believe Ball is able to benefit from its superior operating expertise compared to peers. Specialty can making is a complex business. That's why you see, on average, the specialty can line has much lower capacity and asset utilization compared to commodity can lines. So we have an example of Ball's facility in Fairfield, which can produce 7+ SKUs and is running at 90% plus capacity utilization. So if we assume incremental improvement in Ball's overall product mix, say every 2% increase in specialty can penetration will translate into about 2% increase in pricing. Second, Ball has the broadest footprint within North America and enjoys co-location benefits with its facilities on average only 200 miles away from customers, which leads to its optimal cost structure compared to competitors. Last but not least, compared to Ball's closest global competitor, Crown, we think Ball is able to increase its capacity faster through brownfield expansion, which actually has higher IRR compared to greenfield. When it comes to greenfield projects, Ball also plans far ahead of Crown and runs more scalable production lines.
And then when we look at the third thesis, when we look at the other two segments, they're actually expected to grow faster than beverage cans. So the new aluminum cup is being launched this year and has a lot of cool features. It is recyclable. It's more durable and has better temperature control than plastic red Solo cups. It can also be customized for advertising purposes and sold to waste managers after usage. So we think the cups will generate even higher returns than beverage cans. And we expect the company to sell at least 2 billion cups a year by 2024. And that would add about 19 cents of EPS. And then the aerospace segment has grown at more than 20% annually since 2016 and is expected to continue to grow at double digits for the next 5 years or more, based on large contracted backlog and exposure to fast-growing markets such as Earth observation and space missions. So when we put together all these projections, we come to an EPS of $5 in 2024. And that's mostly driven by the growth of the three main businesses. And we are slightly more bullish than consensus, mostly because we see Ball growing faster than peers. We're also confident in the structural shift out of plastic. And we see that the street overlooks aerospace and aluminum cups contribution. So when we look at valuation, we expect an exit multiple of 23 times PE in 2024, based on continued runway for growth into the following 5 to 10 years, as cans substitute plastic, which would generate a huge opportunity in water. And that would generate a price target of $115 and an IRR of 15%.
So why now? Throughout 2019, the market was pricing in some of the growth drivers that we've been mentioning throughout our presentation. However, in the midst of COVID-19 outbreak, Ball's multiple contracted significantly. We believe that because of Ball's resilience to market downturn, the COVID-19 outbreak, will not have a material impact on its earnings. We predict that similar to what happened in 2009, Ball will be able to recover a lot faster than the market. In terms of risks, some of the risks that we see are lower demand, increased competition, and supply constraint. While these risks do present a negative outlook if they materialize, we believe that Ball will be fine because Ball has been investing significantly in not only educating the world on the benefit of utilizing aluminum can, but also investing in its facilities and technology to be able to meet future demand. With that, we'll open up for questions. Thank you.
Okay, panelists, you can unmute yourselves. And who would like to ask the first question?
Who's drinking the Kool-Aid? And I went back, I know a little bit about the company. This is Lee Cooperman. you know, this stock was a 10, 12 multiple stock for most of the last decade. And I think they sold themselves as an ESG play. And they had the benefit of the synergies from the Rexam deal. It would seem to me it's not a 20 multiple business.
So I guess the question is, maybe you can spend a little more time
On justifying the valuation. I mean, they've done a good job, but I think the stock has really reflected that.
Yes, absolutely. So if you look at slide 38, we see that slide 38, we see that what's changed really is the growth, right? The growth projection. The last 2 years, the volume of beverage cans has grown at 4% and 5%, 4% 18 and 5% 19. And it is expected to continue to grow at least 4% over the next 5 years, and then even longer than that, right? So that's what's really changing the company from a valuation perspective here, and that growth is expected for the first 5 years to be mainly based on changing consumer preferences. So cans are getting more favorable for beer and other alcohol products, and then later the huge growth that they can find in the water market. So if you see, the water penetration right now is it's about 1%, right? So and that's not really expected to change over the next 5 years. But once regulation starts hitting water, you know, they can find a huge growth, huge potential for growth, and for cans to gain market share in beverages.
You have like straight line growth. In 2017, the earnings dropped 7%. In 2018, they dropped 2%. Yet we have a straight line growth in what is basically a GDP company. Whatever, just an opinion. I know a little about this one.
Right, the 17 and 18 were years where they're putting the synergies, right? Like they were working on the synergies of the acquisition. The Rexam acquisition was closed in 2016. It was basically a merger of two huge players, and then they're now on a position to grow it from run rate and from greenfield investments.
Hi, it's Dahlia. Is this a commodity price linked business? Will the price that they can sell their cans for be linked to what they purchase the aluminum for? Have you guys tracked that?
It's linked to commodity. Actually, we have a slide on this. It's linked to commodity, but the way the contract structure is, they can pass through almost 100% of unfavorable headwind in commodity. So that's a non-issue.
Do they hedge out the commodity or not?
Yeah,
Sorry,
they can.
What is the question?
They can pass through.
No, but do they hedge it out? Do they lock it in?
They don't need to hedge. The contracts are pass through, right? So the clients pay a premium on the cost of the commodity.
So then how do you
it's fully hedged.
Right, but so how do you get the transition from legacy commodity cans or 12-ounce cans to the higher margin cans? Is that just, you know, it's commodity price plus X% versus commodity price plus Y% and both float, but they float with different increments, or?
They're sold for different prices. So each contract has its own, each contract is different, right? So they sell basically these contracts to these cans to the companies based on their cost, right? Mm-hmm. And their ability to gain pricing power on the commodity cans is lower than on the specialty cans, where they're really the only player that has strong capabilities on these products.
How much of their revenue do you think is tied to high population density type of facilities like sporting arenas?
It's actually really low. Most of their volume, so we're talking about between 80 and 90% of the volume, is for home consumption. So they're very well insulated to that to that risk, because most of the products are sold in supermarkets and people consume them at home.
Hey, it's Jillian here. Can you talk us through your your bear case in a little bit more detail? Because I think that you know, some of their peers or you know, customers, sorry, like Coke and Pepsi, have talked about some weakness in places like Brazil and Europe. And then secondly, just if we are going to a sort of economic slowdown, you know, what does it actually mean what's sort of the headwind on the product mix, you know, as we think about consumers trading down rather than trading up? So if you could talk us through your bear case, that would be helpful. Thank you.
Yes, I'll talk about the bear case, and one of my teammates can help me on the other question. So in the bear case, so the growth, a lot of the growth for at least the next 2 years is contracted, right? So they're growing, they're building new facilities, but before they start building these facilities, they sign contracts with the large anchor clients, right? So the bear case has a 3% growth, a CAGR in 5 years, but actually after the next 2 years, that's only a 1.5% growth. And a lot of the growth here, again, comes from players, for example, in hard seltzer, for example, White Claw. Right now, there's a product that's booming, and they're expanding production because they're seeing demand. So that's on the bear case.
Okay.
Maybe I could push a little bit on Leon's question. I think when people think about this business, they think of, you know, the aluminum can business as a commodity business. Maybe you can tell us a little bit more about the competitive dynamics, who the other competitors are. Is there something proprietary about their specialty can business that enables them to maintain pricing? Because usually in commodity-like industries, you see pricing, particularly when you have, you know, a lot of concentration in the beverage industry. It would seem surprising that they would be allowed to earn such attractive returns.
Yeah, so in terms of competitive advantage, some of their main competitors are Crown and Ardor that you see right there. They have different product mix. So Ball is basically the only one that mainly focuses on aluminum beverage can outside of just this aerospace, while Crown and then Ardor have different, excuse for the background noise, while Crown and Ardor have different product mix. But in terms of Ball's ability to be better competitor than its to have a competitive advantage than its current competitors, it's aligned to two things. One is the footprint, the other one is the product mix. As Lou mentioned in her presentation, Ball has about 32 SKUs, and in the US alone, Ball can produce all these SKUs in different types of region across the world, while its closest competitors can only produce in 2. So they don't necessarily have the footprint to be able to serve a lot of the customer needs. And then the second thing is a product mix. So not having the right product mix, such as not being in the specialty environment, which is very booming right now, or even having the right types of SKUs to be able to meet customer demand, is really something that's making it hard for their competitors to win contract. And as we mentioned, Ball has been able to capture about 80% of the contract over the next 2 years in North America.
Yeah, so the specialty cans is what's really driving the growth here in this market.
Yeah, so
Crown, let me get a
Crown.
Mario's turn. Mario. Go Mario.
Sorry,
yeah, Lee. Before you do that, Lou or Raphael, I forget who covered the aerospace. My best guess is aerospace is 10 to 15% of revenues. Have you considered monetization of that asset to accelerate the deleveraging or to do some other strategic acquisition? And what do you think they could get for that part of the business?
Yes, so right now it's growing really fast. So the backlog is good. It's growing fast. The last couple of years, it's grown at 20% plus. So I don't think they're actually interested in divesting, just because there's a lot of potential there. And some of that potential is tough to quantify. I'm not sure if other players would pay the premium for the growth that they believe here, which is based on the relationship with the U.S. government. So I don't think that's something that they are willing to do.
Thank you. Just asking whether, go ahead, Lee.
Go ahead, this is Lee. Let me just observe. In 2005, the low multiple was 13, the high was 14. 2006, same thing, about 12 or 13 to 14. 2007, 13 to 15. 2008, forget about it, the multiple was 7 times. The multiple you have now at 24 times in your forecast for 2024, that's higher than Google sells at in the way of a multiple. And so I look at where stock is selling absolute and relative historical valuations. You're coming in this thing near the high end of its absolute relative multiple range, and it's really basically a GDP type of grower.
Okay, so I guess I apologize, but we're now over the timing for questions. Okay. But I thought that was an excellent presentation. And John, you get to ask the first question on the next panelists. And Meredith, why don't you bring on the next group? But thanks very much, Ball Corp. Excellent job, guys.
Thank you.
Thank you.
Thanks, guys. The next is Broadridge Financial Solutions. Caroline, and whenever you're ready.
We are ready. Hi, I'm Rainbow and I'm joined by Ryan and Michelle. We're here to pitch Broadridge, a hidden gem in plain sight, a financial technology powerhouse that is recession and COVID resistant, with 98% client retention, a cash cow with strong recurring revenue growth and a conservative balance sheet. This hidden gem is undercovered by only 9 analysts, and they're penalizing Broadridge as a cyclical business when it is a long-term compounder with 2 high-quality secular growth franchises and tremendous opportunities to cross-sell within its large client network. We believe this presents a 54% upside, representing a 16% 3-year IRR. Let us tell you why. Spun off from ADP, Broadridge is a market leader in providing mission-critical financial technology solutions and has consistently delivered 20% ROIC. Here are the 3 reasons why we think Broadridge is a compelling stock and why now. First, it is a high return cash cow protected by a wide moat. Second, there's significant revenue growth opportunity in wealth management. 3, there's margin expansion potential with shift in sales mix accelerated by outsourcing trends. Broadridge is a key technology connector within the financial services industry, offering solutions in 3 verticals: investor communications, global technologies and operations, and wealth management. If you have ever facilitated a proxy vote, obtained a trade confirmation, or received marketing material from a financial advisor, then you may be one of Broadridge's end consumers. To better highlight the importance of Broadridge, let's take a step back to imagine what the financial services industry would look like without it. 80% of North American public companies and asset managers and 50% globally will need to find new proxy voting solutions. 90% of broker regulatory communications will be lost. 80% of North American households will not receive 5 billion customer communications per year. 5 trillion of daily trades across 80 countries will not be cleared and settled. And finally, 25% of US financial advisors will not be able to communicate with customers. So being at the forefront of such mission-critical services has provided Broadridge with a highly resilient business model. Because of its importance, Broadridge has built a large network of stable top-tier global customers. This ability to continually tap into this network is highly underappreciated, and we believe that this will be the springboard for Broadridge's future growth opportunities. Even without further upselling and new product launches, Broadridge is an extremely compelling business. 63% of its revenue is recurring, with 98% client retention and 6-year average contract duration. We believe this is a unique time to engage. Stock price has gone down 15% since earlier this year due to historical low level of proxy fights. We believe the market is overly penalizing Broadridge on the short-term cyclical event-driven revenue that only makes up 4% of sales. While Broadridge is in fact a long-term compounder with 2 secular growth franchises in wealth and global technology operations.
First, Broadridge is a high return cash cow protected by a wide moat. Recurring revenue has increased 9% per year with an average of 5% organic revenue growth over the past 3 years. This is not only driven by its 98% client revenue retention, but also by strong closed sales, leading to a healthy backlog and ultimately providing significant downside protection in today's current volatile market. Broadridge also has high cash generation capabilities supported by strong ROICs and has low market correlation, even during the last recession. Based on our discussions with industry professionals, the high ROIC is protected by high barriers to entry within the industry, including deep industry know-how, significant investment in infrastructure, high switching costs, and strong reputation requirements as services are mission critical. Further, the Broadridge model is difficult to replicate given Broadridge's large relationship network favorable to cross-selling, economies of scope and scale, superior talent and organizational structure, and a prudent M&A strategy. Our analysis also shows that even though Broadridge has different niche competitors in each vertical, Broadridge's breadth and depth of solutions is unparalleled. Under investor communications, Broadridge is a clear market leader given its 80% market share in proxy services and household reach. While Global Technology Solutions is more competitive given existing industry players, Broadridge benefits from cross-selling into its investor communication relationships, leading to significantly higher win rates and lower client acquisition costs. Wealth is an interesting new emerging focus. Although there are similar existing piecemeal solutions, Broadridge is the only player with the ability to integrate with a robust offering of existing product lines and to create an end-to-end solution. Our research indicates that there is an attractive and underappreciated growth opportunity in wealth management for Broadridge. Our research further suggests that 1, global wealth management TAM is increasing, and 2, wealth tech remains a fragmented industry with lack of an integrated solution. As the private wealth VP at Capital Group told us, this is a significant pain point as it creates overhead in managing multiple vendors and there is high risk that systems cannot seamlessly talk to each other. These industry trends create significant growth opportunity for working with a single trusted vendor such as Broadridge. Our research shows that Broadridge's integrated front to back end wealth solution is currently the most well-rounded on the market. And discussions with Morgan Stanley's Wealth Tech VP also confirmed that an end-to-end wealth management platform is unheard of because of its complexity, thereby confirming Broadridge's technological capabilities. Recently, Broadridge successfully partnered with UBS, a top 5 wealth manager in the US. UBS's president describes Broadridge as the only fintech leader with a proven technology, scale, and experience to deliver such a transformational solution. We believe that Broadridge could likely continue to secure new large clients. And we also believe that there is a large opportunity to upsell to existing clients who currently only use one part of Broadridge's various advisor solutions to a more integrated full suite solution. Lastly, over the past 3 months, our research shows that there has been a 4x increase in traffic to Broadridge's advisor website, showing that there are strong early signs of interest and demand for their solutions.
So now we are going to dive into Broadridge's margin expansion potential and how a shift in global technology and wealth are driving this change. Historically, global technology and wealth offer higher margins than investor communication, and over time, the share of total revenue coming from lower margin businesses like distribution have declined as Broadridge focuses on digitalizing the side of the business. We believe that the shift towards global technology is highly likely, given an estimated 5% yearly increase in total cost outsourcing. Given that Broadridge works with the majority of fixed income dealers and North American banks, we believe that there is a significant opportunity to upsell a global unified solution and offer more outsourcing opportunities. Broadridge has pushed a digitalized proxy delivery, lowers costs for clients, produces higher margins for Broadridge, and has led to $200 million in recurring revenue. We believe digitalization will be further accelerated post-COVID as more companies move towards online delivery. When looking out to 2023, we see a path to a 270 basis point expansion, led by global technology and wealth increasing due to operating leverage, and the investor communication segment's margin enhancement through the aforementioned digitalization. Recent M&A from the company targeting these trends will only help to realize this margin enhancement. And roughly 29% of this estimated EPS expansion is due to an increase in wealth revenue, and 32% comes from investor communication and global technology recurring revenue expansion. We believe that consensus misses Broadridge's opportunity to further grow and compound future revenue, as well as underlying fundamental changes to its future margin profile, ultimately benefiting the bottom line. We arrive at a weighted price target of $174. We believe that our bear case is highly pessimistic, with no additional revenue coming from new wealth management sales and recurring revenue at lower levels than historical. Our base case, with 20% wealth market penetration and recurring revenue similar to recent performance, implies a price of $177. Our bull case with 30% market penetration in wealth implies a price of 253. With a risk reward profile of 2.6x with a quite bearish bear case, we believe that Broadridge presents an extremely attractive opportunity in such turbulent market times. We also believe that Broadridge is uniquely positioned to weather out the current COVID storm. About 2/3 of their operating cash flow comes from recurring revenue, and a large portion of their cash outflows in recent years has been discretionary spend, including buybacks and dividends. Even with buybacks and dividends, Broadridge has sufficient space on its $1.5 billion revolvers to draw down if necessary. And there are 3 key risk areas here that I'd like to address. First is client concentration risk. We believe that Broadridge's mission-critical solutions and 98% client retention rate make this revenue quite durable. Second is client loss from M&A. We believe this also creates upside for Broadridge if the merged entity decides to stick with the Broadridge solution. And third is volatility and event-driven revenue. We believe that growing AUM and activist hedge funds and a push towards ESG are potential tailwinds for this. To recap, Broadridge is a hidden gem, a COVID and recession resilient cash cow that is supported by conservative financing. It has a large underappreciated client network that will power significant cross-selling opportunities into wealth and global technology operations. Broadridge has the power to play offense through this crisis and the right management team to continue executing. Thank you, and we'll now open it up for questions.
John, do you want to lead off?
Yeah, sure. It seems like it's a unique company providing important plumbing to the financial sector. But I'm not really clear who the competitors are and where Broadridge ranks in the competitive landscape. I mean, how big are the competitors? What's the market share?
Also, in this page, you can see all the competitors that are serving in different niche verticals. And what is very unique about Broadridge is their ability to cross-sell across multiple different verticals, from investor communications into global operations and then wealth. And if we're taking a look at market share, in the proxy business, currently, Broadridge has an 80% market share. And if I pull up the slide, you can see that in other businesses, they're already working with some of the top players within the industry, even though they don't have full disclosure on exactly, the market share in each of those verticals.
The stock had a hit in the middle of, I think it was like June 2019. Is there a reason for that?
June 2019.
We can go to the slide. Yep.
Sorry, mid 2018.
Yes.
So in mid 2018, that was again post event-driven highs. It had event-driven highs for event-driven revenue. That was roughly about 30% past the previous year, and that was mainly due to the Mondelez Trion fight. So it got inflated and then deflated right after. And it actually will probably continue to deflate this event-driven revenue, which has actually made us think that this is a really interesting opportunity if you think 3 to 5 years out and event-driven revenue stabilizes to its 8% growth rate.
It's Gillian here. Could you just talk on the management team? You said that it's got a good management team, but one of the things I noticed about the company is that it's had a pretty high turnover of management. And I think actually during that 2018 period, I think both the CEO and the COO resigned. So if you can talk to that, and also the audit fees are very, very high. It's an outlier there. So maybe you can touch on those 2 things. I mean, they're really, management's so important if you're going to underwrite the position.
Sure, I could first talk about management. So Richard Daly led up his role as CEO to Tim Goki in the beginning of 2019. And we actually view that as a potentially great step for the company, given that he comes from more of the global technology side, and that's where the higher margins are. And as you can see here, most of the executives have been at the company for at least 10, 20 years. And recently they actually appointed Mike Alexander, who's heading up wealth, who's been with the company since 2006. So they definitely reward people that stick with the company and want to put them in place.
So it's Bill, if I may ask a couple of questions.
Sure.
So how do you think the customers of Broadridge perceive Broadridge?
Rainbow, you want to take that?
Yep. So taking a look at this slide again. Whoops, sorry. Yeah. These are all of their clients, and majority of them, they are top tier players that have extensive relationship with Broadridge for many, many years. And we've actually spoken to a number of their clients. And what they're telling us is what differentiates Broadridge is not only their unified solution that it's crossing between governance to global technology operations to wealth, but at the same time, they're also much more client focused. They focus on understanding the consumer demand while creating a product and co-developing systems with them. That is something that we think is extremely unique in the market versus a lot of the players out there that no longer have these existing relationships. They're not able to create a product that is going to meet the demand of the market.
Okay, so let me give you a perspective on the company, and then and just a risk that I'd love to hear your thoughts on. So it may surprise you to hear this, but many of Broadridge's very, very large clients hate the company. Okay, if you talk to the activist shareholders who are effectively forced to hire and pay Broadridge, they view the pricing as extortionist, and it is. My view of the company is it's a bad monopolist. They've been in a monopolistic position, and the pricing is just, it's extremely aggressive, and the customers feel the same way. Vanguard recently did 2 years ago had to do a solicitation to change elements of their relationship with their clients, and it cost them something approaching $100 million to do a proxy solicitation of the Vanguard client base. And Vanguard is a company that is very focused on costs, and for a service that seems very much antiquated. I'd also point out the company has very kind of legacy, old-fashioned technology. Their customer interface is very old school. The way they price for services is complex and not sort of value-added pricing. So I'm giving you I have the benefit of sort of an inside knowledge on dealing with the company. How do you respond to those kind of allegations, and have you looked at some of the fintech recent startups in the last several years, including a company called Say, which is working to disrupt BlackRock? What do you think of the risk of disruption, and what do you think of those sort of thoughts?
So Brian, I think you can probably tell your story speaking to a number of the wealth manager out there that are in the startup space who have actually had both experience in the government.
Yeah, so first I would speak towards the recent UBS win, and that's bolstered a $330 million backlog of revenue in 2019. And we also spoke to a bunch of new wealth management startups or kind of new firms that are out there, and all of them spoke to their previous experiences dealing with Broadridge solutions on the advisor side and their GTO side, and saying that Broadridge customer service came on the site, dealt with them, walked them through, and they very much appreciated the Broadridge service. While the legacy business on the governance side might be antiquated, their push, and as you can see with their shift in revenue, is going more towards the GTO and wealth. And I think that's where the future of the company is going.
This is Lee Kuberman. I disclose I was chairman of the audit committee for 20 years of automatic data processing, and I was there for the spin out of Broadridge. This company was built by Rich Daly. He's 66 years of age. I know he kicked himself upstairs. I don't know what his long-term, I'm not current on the company, so I just pose questions. What is the background of the management behind Rich? Rich was the builder of this business, and he's, like I said, 66 years of age. You use the term a hidden gem. This stock has gone from 20 to 116. It's not been that hidden, as best as I could tell. Thirdly, I was very surprised when we spun it out of ADP that nobody bid for the company. And when I delved into it, I figured out that the big problem was people did not see the revenue growth. Okay, so you look in 2018, their revenues rose 4.5% year over year. In 2019, the revenues were flat. The consensus estimate is for revenues this year to go up by 2.6%, in 2021, 5%. So you're putting a growth multiple on a low growth business. If Bill is anywhere near right about their technology being subject to challenge, it could be a dangerous stock. But I think that this is a terrific company. It's done a great job. And I put a lot of this on the doorstep of Rich Daly. But, can you address, you talked about the 9.8% revenue growth store for store, but their overall revenue growth has been much more moderate than that. So where are they losing market share? Where are they losing business?
Sure, I could first take management. We could pull up the management slide. So as you can see here, all these Broadridge executives, the one with the least amount of tenure has been there since 2014, and that's Chris Perry, and he's taken the role as president. And we've personally spoken to him, and he's been in charge of leading this effort towards GTO and wealth. And towards your point of Rich Daly, he has taken a step back, given that he was with the legacy ICS business, and also he still is the largest insider shareholder. And to speak to their incentives as well, most of their incentive compensation is actually with long-term stock options and RSUs. And that's with growth in EPS and also share price appreciation. So combining that with their tenure, I think that they're stable, they're levered and incentivized for the long term. And then what was your other question?
I just made an observation. You said it was a hidden gem. It went from 20 to 116. Somebody found it.
Rainbow, you want to take
the most important question I presented is, you have a growth multiple on the business. Their revenue growth in 2018 was 4.5%. 2019 was under 1%, and the consensus is for revenue growth this year of 2.6 and next year 5%. And you showed a chart in there that had revenue growth near 10% compound, okay? And so the revenue growth I'm looking at does not justify a big premium PE. And secondly, the two biggest sources of your growth and earnings are not high quality. Well, one is not high quality. Share repurchase, I don't know how you figure out 58 cents growth. If the stock doubled, would it make sense to buy back stock? Probably not. They're not buying back anything terribly cheap. And then you got the margin expansion in a world which is getting more competitive, and they already have very high margins. And if Bill is right that people are going to be nipping at their heels, you wonder whether they can expand the margins like you think. I don't know. It's a very good company, though.
We're out of time, but we'll give.
Can we address this question?
30 seconds.
Sure, I'll address this question here quickly. So if you look at this EPS bridge, only 15% comes from share repurchases, and that's in line with what the company has historically done. They've, on average, historically used roughly $250 million to repurchase shares. And then if we go to the income statement quickly to take a look at the different revenue lines, you'll see that what has negatively affected the business was after their NACC acquisition, which actually has opened up the doors to digitalize the business and upsell different financial clients. You can see that distribution and event-driven revenue has been the loser of all the revenue, whereas ICS and GTO recurring revenue has actually continued growing extremely fast. And this company was a 30x NTM EPS company when the event-driven revenue spiked, and that's actually at a smaller scale than the ICS and GTO side. So I think if you can get the wealth kicking in and ICS and GTO continuing as they are, this could be a 25 to 30x NTM EPS stock.
Okay, we're going to stop there. Again, very challenging questions, handled very well by the panelists. I want to thank you for an excellent presentation. And Meredith, let's go to number 3.
Yep, next up is EPAM Systems. Okay, guys, whenever you're ready.
Thank you, Meredith. My name is Manas. My teammates Akshay, Amitabh, and I are happy to be pitching EPAM Systems today as along. EPAM is a best-in-class software engineering company with a pure-play focus on digital technologies. As of April 28th, it had a market cap of $11.5 billion, and FY19 revenue was $2.2 billion, and it has grown organically at 25% CAGR for the last 5 years. We've been conservative with our FY20 estimated EPS, which is why we have the stock trading at 40.2x on a one-year forward PE basis. But if you normalize the likely short-term dislocation from COVID, the stock trades at 31.9x on a one-year forward PE basis. We'll delve into this further in due course, but our broad investment thesis is based on the fact that EPAM is a long-term compounder with strong growth potential and asset-light, cash-generative operations. Our target price is $415, with an MOIC of 2x and IR of 20.6%, assuming an approximately 4-year holding period. That is, assuming we exit December 2023. Just to give you a quick overview, as mentioned, EPAM is the largest pure-play digital software engineering company. Its clients are largely in the US and Western Europe, which collectively comprise greater than 90% of revenue, but of its 36,700 employees, approximately 85% are based offshore in Belarus and Ukraine, and 60% of revenue consists of clients from financial services, software and high-tech, and media and information. As mentioned earlier, the company has grown organically at 25% CAGR over the last 5 years, underpinned by strong overall industry tailwinds, as well as its ability to deliver best-in-class service quality with 90% client retention and 10+ years of average top 20 client life. Just to quickly go over some of its clients. So for UBS, EPAM did end-to-end design and development of their robo-advisor mobile application. For Bridgewater, it standardizes their data for input into their trading algorithm. For Mercedes-Benz, it both designed and developed their in-car infotainment systems and digital cockpit. So as you can see, all of EPAM's work is highly mission critical, and they work directly with the front office revenue generating center of their clients. If you had bought EPAM at IPO on Feb 9, 2012 and exited on April 28th, so 2 days ago, you would have made 41.5% annualized return. Just to quickly go over some of the investment factors, EPAM operates in a $150 billion core addressable market that is growing at 13% year on year. The outsourced component of this is growing even faster at 18% due to increasing penetration and is currently approximately $30 billion or 20% of the market. Secondly, EPAM is a market leader with demonstrated abilities to scale. It's the largest player in its market and 3 times the size of the next largest player. Thirdly, our research indicates that the street is under forecasting current pipeline and growth potential and has done so consistently by approximately 300 basis points. Conversations with industry analyst management and others confirm this. Lastly, revenue growth is supported by asset-light operations and strong cash generation. As mentioned earlier, organic revenue CAGR has been 25% over the last 5 years. And EPAM has a large cash balance of $936.6 million, or approximately 9% of market cap. EPAM is also currently debt-free. Over to Amitabh to dive deeper.
Thank you, Manus. So really the first compelling investment factor is that EPAM operates in a vast addressable market of $150 billion, growing at 13% per annum. Our primary research reveals that a lot of organizations and clients are at a very early stage of their digital spend, and that at least 10 to 15 years of strong digital IT spend remains. So there's some very strong and structural tailwinds around digitization and software enablement. Within the $150 billion market, about 20% is outsourced to third-party vendors such as EPAM. As digital technologies mature and see greater adoption, the outsourcing penetration is expected to increase to about 24% by 2024. So while the overall market is growing at 13% per annum, we expect the outsourced component to grow faster at about 18% per annum over the next 4 to 5 years. So if you look at the overall IT services landscape, we'll notice that it's a fairly diversified landscape. The largest bucket is really the one in the middle, which includes the large IT consultants such as Accenture, IBM, Capgemini, TCS, and Cognizant. On the right of that are the offshore Indian vendors such as Infosys, Wipro, who have historically focused on labor arbitrage and cost takeout of back office IT systems. And then when you look at the pure play digital vendors on the left, you'll notice it's a very limited peer set. And in that peer set, EPAM really stands out as a market leader. So benchmarking EPAM to its digital pure play vendors, a few things really stand out for us. As mentioned earlier, it's thrice as big as the second largest player, which we think is a very important differentiator in a very people-intensive, client-intensive, and project-intensive industry such as IT services. Secondly, despite being thrice as scale, it's continuing to grow just as fast at 25% organic CAGR, showing very little signs of reaching maturation. And thirdly, it has a far more diversified revenue base, which is extremely important in an uncertain and dislocated environment such as today. So really, the secret to EPAM's success has been the quality of its service capabilities. We think that the chart on the left is a very compelling indicator of its business quality. If you look at the chart on the top, you'll see that the average revenue per client has grown from about $4.9 million in 2016 sequentially to about $5.9 million in 2019, and client account sizes have been scaling up organically. This to us reveals 2 things. First, that client demand is increasing in digital IT. And secondly, because of its strong service capabilities, EPAM has been able to consistently win that increasing client demand and grow its business organically. And this is also validated by client testimonials on the right. So if you look at Bridgewater's CIO, and Bridgewater is a top 10 client for EPAM, the CIO basically came out and said that EPAM is best in class and all they can do better is offer more people to Bridgewater, which we think is a very strong validation of EPAM service qualities. And as mentioned earlier, 85% of EPAM's employees are based in Eastern Europe, and they've been seeing strong pricing power over the last 5 years. EPAM has been able to scale up its employee base at about 21% annually, while maintaining industry-leading voluntary attrition rates, which we think is a very important KPI in a people-intensive organization such as EPAM to assess employee satisfaction. From our research, we come to understand, after talking to the CFO, talking to other management team members, clients, and industry analysts, we've come to a very firm realization that demand is outpacing supply for EPAM services, and that EPAM is actually having to catch up to demand on a year-by-year basis. We think this is a very good position to be in. So if you go to the next page and you look at sell-side estimates over the last 5 years, and then you benchmark that to how EPAM performed over a forward 3-year period on an organic constant currency basis, EPAM has outperformed estimates year in, year out by about 300 pips. This is because sell-side and the market fails to recognize that demand is outpacing supply for EPAM services, and that as a result, EPAM always has a recurring pipeline of future projects to work on once the supply becomes available. After speaking and after reading equity research reports and then talking to EPAM's clients and management, we realize that this is a trend that's pervasive, something that continues right now, and something that's going to continue going forward, and therefore we expect EPAM to be an outperformer going forward as well. And lastly, if you just go back a slide, you'll notice that it's a long-term compounder. It's grown 25% organically over the last 5 years, stable margins, asset-light operations. As a result, it's been an absolute cash machine. It's gotten almost $1 billion of cash as of 2019, which is about 9% of market capitalization, and it remains debt-free. I think this provides the company strong insulation in the current environment and a lot of dry powder to pursue inorganic growth or maybe allocate some cash back to shareholders going forward.
Thank you, Amitabh. So we believe that the current valuations provide a compelling entry point into EPAM. We decided to look at valuations on an LTM basis here, given the uncertainty in forward 2020 estimates right now. The discount relative to both intrinsic value and peers, despite EPAM's larger size and similar growth and margin profiles, points to strong underlying fundamentals and its success in surpassing the barrier to scale that we talked about earlier. And now breaking down the drivers behind value creations, we believe that growth in organic revenue will continue to be the primary contributor as it has been historically, complemented by acquisitions and margin expansion as the company scales its business. And now looking at the different segments, the software and financial services segments will continue to be the largest contributors to revenue growth, despite the setback from COVID-19. Travel and energy, which is part of the emerging verticals, constitute about 10% of the revenue and are expected to see a prolonged impact of COVID-19, especially over the next 2 years. And it is reflected in their contribution to overall revenue growth as well, as you can see. And based on our discussion with the company and also some of the investors and industry analysts, we expect the company to continue its acquisition strategy on the back of its strong balance sheet and also begin active capital allocation, which can provide a potential upside of 1.4% to our base case returns and give us a return of 22%. And now taking a look at the different cases, we believe that EPAM provides opportunity for significant upside from our base case. In our base case, we have assumed revenue decline in the travel and emerging verticals over the next 5 quarters, with the verticals reaching the FY19 level close to the time of our exit. We have also assumed reduced spending by customers in other verticals till FY21, along with some cancellations given the current economic environment. However, if the economy starts opening up during the second half of 2020 as expected, it will lead to a less severe impact during FY20 and 21, and this could provide significant upside to our base case with an IRR of 31.8% in our upside case. And now quickly moving on to the risks. Like any other company, EPAM faces risk from its competitors, COVID-19, and potential impact on its cost structure. However, we believe that EPAM is equipped to handle any such challenges given its strong business fundamentals, market leadership, and mission-critical nature of its project, and we can delve into these further later. And now just quickly recapping the investment factors, we believe that EPAM is a long-term compounder with asset-light operations, strong organic growth, and high cash generation potential supported by structural tailwinds and potential upside from its strong balance sheet. Therefore, given the strong industry growth potential over the next 10 to 15 years and EPAM's position in the industry, we believe that EPAM provides a compelling growth story, and right now is the perfect time to become a part of it and invest in the company. And we believe that our base case price target of $415 in December 23, which translates to an IRR of 20.6% and MOIC of 2x, is achievable with a strong potential for upside. Thank you, and we look forward to your questions.
Okay, who would like to go first?
Yeah, maybe Bill, I'll go first if you don't mind. Tell me, what are the competitive barriers? Maybe I'm correct. This is like an outsourced engineering firm. Bespoke services, they make the sale and then they produce offshore to lower the cost, I guess, and compete on price. How much of the engineers are located outside the US?
So Johnson, 90% of the engineers are outside the US, 10% of engineers are on the US.
Okay.
Actually, yeah. So if we go to page 55, please, this really, sorry, yeah. So
all right, so that's their cost advantage. So they get the front office in the US, they provide the services that the companies don't have. Yeah. But what's the competitive advantage? Why can't like one of the senior executives leave and then replicate it and compete against the same client.
Yeah,
how sticky are the clients? Do they get inside the company that once they're inside with a client, it's difficult for the client to switch to another vendor?
Absolutely. So when we spoke to the clients and we spoke to management, one thing that came out obviously is that a lot of these projects are basically contractual, but each of the project can be canceled within 30 days notice. So we think contracts are an overrated barrier. We think the barrier is more organic. It basically comes down to disruption risk. So if you go to page 56, you'll basically note that usually the projects they work on with clients is basically 1 to 2 years long, but they're usually part of a longer 5 to 10 year roadmap. And for example, they've been working with Expedia since the early 2000s. So anytime Expedia now basically develops an incremental module on their website or app, they're going to naturally come to EPAM. The other thing to note is that, in software engineering, there are basically two paradigms. The first paradigm was the waterfall model, where you basically design everything up front and then you engineer. The new paradigm is agile development, where you basically design, consult, engineer, develop, iterate all at the same time, which is why you might have seen, beta versions of software now. Because of that, it's very difficult to disaggregate individual work streams and basically give one work stream to one vendor, one to another vendor, or move some in-house, move some to an external vendor. So for that reason, EPAM really provides an end-to-end design and development of the entire product suite. And, that makes it by nature a lot more sticky and a lot more recurring.
Okay, can I just follow on from John's question? So, 60% of their business is actually in the US. So aren't they dependent to some extent on H-1B visas, getting folks to come in and sell into the US? And then secondly, can you touch on the accounting? Is it percent of completion accounting or, that sort of accounting is ripe for SEC investigations and such. Yeah. So can you touch on that? Thanks.
So just to answer your second question first. So all of the accounting is on a T&M basis.
Okay.
So it's on a unit basis, so there's no percentage of completion. And we spoke to management about this, and they actually prefer a T&M basis because a lot of their work is so bespoke, it gets very tough to basically predict upfront what the revenue is going to be from that project. So they basically do it on a unit basis. They're the only IT player, in fact, who's moved to a T&M pricing. Everyone else has moved to a fixed pricing over the last few years. Manas, if you'd want to take the first question on the H-1Bs.
Yeah, sure. Just to jump in as well on the T&M side, it's about 90% of revenue is T&M. On the H-1B side, so yes, they have salespeople that sit here as well as Europe, but all the delivery professionals, as mentioned, 85% of them sit in Belarus and Ukraine. Also, they haven't built as much of a sales organization as some of the other companies. It's largely been word of mouth, and it's been a beautiful model for them so far. They are looking to sort of build that up, and we have sort of baked that into our assumptions.
Just to pitch in on the sales part. So they have had a team of 100 sales employees throughout the last few years, and talking to the management, they feel that they are very well equipped for the growth over the next few years based on that 100 people that they have right now.
Yeah, hi, Lee Kuberman. Kind of pithy observation. I noticed that 12 analysts on Bloomberg had as a buy, but their average price objective is 224. The stock is 221. Okay, you're projecting 20% compound returns, which matches off the earnings. So if you're right in the earnings, I suspect you'll be right in the stock price. The other thing I find interesting, of the major holders, none of the high-tech mafia are in these things. In other words, the Chase Colemans of the world and the Tiger Cubs that are very technology-oriented. The Cotu, I think, is a well-regarded technology guy. I don't see any of the classical, highly regarded long-term technology guys a player here. Is this something about the management that is less than savory, that discourages people? Why are we not seeing the traditional technology players involved? I don't know if it's significant or not. I just asked the question.
So on the average broker price, Lee, there were 4 brokers who came out with an updated report last week after COVID's impact. And if you look at the updated broker price from those 4 different reports, it comes to close at about $235 to $240 per share. The share price did rally 10% yesterday. So it was $208 when we sent the deck in. So that was a very strong rally yesterday. And on the second question, Manas, if you'd want to talk about Singular Gulf, I think you have a good perspective on the private equity player.
Yeah, so Singular Gulf went into this company back in 1999. They had a Russia private equity team that went in. So that's on the private equity side. They've had a couple investors in the past, and Singular Gulf continues to hold this company and has a lot of conviction behind it. As far as other long-term investors, there are several. 70% of holdings are sort of long-term, long-only investors. Our impression, having spoken to people, is because it's so difficult to forecast quarters, it becomes very difficult for especially short-term hedge funds to hold it, as to whether, why a Tiger or a Kotu wouldn't hold it. My best guess is perhaps because it's not the typical software business or consumer tech business that they would look at. That said, it still is a high grower, fantastic cash machine, as mentioned. So there's no reason why they shouldn't depart from that, in our opinion.
And we do think that there's a touch of it being undercovered as well. It's not as widely covered as other stocks in its market cap range.
Dahlia.
18 analysts cover it, 12 recommended.
Hold on. Let's have Dahlia. Go ahead. Dahlia, you're up.
Thanks. How much of their revenue each year is go-get, or at least specifically for 2020? How much is in backlog?
Yeah.
And how much do they have to go out and find?
Yeah, so 90% of revenue is visible at the end of, on January 1st, I have 90% visibility on the revenue for the following year. And what really sets them apart from other IT services companies is that 60% of incremental revenue is basically inbounds from clients. So that's why they actually have a much smaller sales force compared to a similar sized digital player like an Accenture, for example, on a proportionate basis would have a far bigger sales force versus an EPAM. And we feel that that's a fairly strong position to be in because they can always grow their sales force and increase their outbound as well.
I'm a little confused. I thought you said that their average contract was 1 to 2 years long.
Yes.
So how do they have 90% visibility every year going in?
Well, there's some contracts would be expiring through the year. So I mean, 90% of revenue is contracted at the beginning of every year, is the way they put it.
Okay.
Normally, if one project gets over with one particular client, just because of the relationships and the fact that the project leaders actually are part of EPAM who are driving the clients, they end up getting more revenue and more contracts from the client. So as you see in one of the slides where we talk about how the penetration has grown within one particular client and how the client sizes have grown, I think that gives a very good indication in terms of the visibility.
Sure,
So
sure, but client retention and same client growth are very different from having a backlog.
Yeah. Agreed.
Okay.
Yeah, so they don't disclose their TCV, their contract value numbers. We can get back to you on that. We don't have that number at hand.
Okay.
Lee, did you have a follow-up question?
No, that's it.
So maybe you can take, what can go wrong? You have a company with a great historical trajectory. You're projecting it to continue. Big disparity in returns, obviously from your bear, what are the components of your bear case? How do we lose?
We see three pillars of loss, as it were. So first is revenue doesn't grow as fast as it has historically. It's a fairly priced, it's at 31 times, it's a fairly well-priced stock, but the revenue has been fairly strong, and maybe revenue growth going forward might not be as strong as it has been historically. We feel that, just on the amount of demand that we've seen from talking to clients and industry analysts, we don't think that that's going to be a very strong driver. The second, perhaps more important risk is really around margins. If you look at a lot of the legacy IT players like a Cognizant or a Wipro, Infosys, who focus a lot on back office IT systems, they see a lot of pricing pressure on a year-by-year basis. Luckily, because EPAM works more with revenue generating centers and actually works on very mission critical work, they're not seeing as much of a pricing pressure as some of the legacy IT guys, but that could be a possible risk going forward, which might lead to margin decline. And secondly, if you look at Accenture, TCS, who are $100 billion growing at 8% a year, they're trading about 25 times forward PE. Maybe if the PE goes down to about 25 times, which is about 23 times PEX cash, that might be another reason for us to lose.
Okay, I think we're out of time. Thank you so much. Excellent presentation. Meredith, let's bring the next candidate in.
Next up is Sysco Corporation. Okay, guys, and whenever you're ready.
Hey, thank you. So my name is Michael, and I'm here with my teammates Kyle and Shaunak. And today we recommend a long in Sysco with a 3-year price target of $103 a share, which represents 84% upside and a 23% IRR. Now, Sysco is a best-in-class food service distributor. We believe that it can accelerate 15 years of market share capture, mostly over the next 18 months. While we forecast a slow recovery across the industry, Sysco's ability to capture share is its largest driver of value creation. Now, this is made possible because of its unparalleled scale, and the new food service landscape will be primed for Sysco. We project EPS to grow 114% through 2024. And we believe that the opportunity is right now. Nationally, restaurant sales have declined up to 75%. Some have completely shut their doors. Over 30% of them may close permanently. But most importantly, our research showed that up to a third of distributors face extinction, and up to 15% of the market share is now up for grabs. Survivability is critical here, and Sysco will not only outlast everyone else, but they'll emerge stronger out of this crisis. Now, Sysco is the nexus that connects a highly fragmented supplier base to an even more fragmented customer base. With 17% market share, twice the distribution real estate of its closest competitor, and almost 50% greater gross profit dollars per trip, our food chain literally cannot exist without Sysco. With coronavirus temporarily shutting down the restaurant industry, and the market punished Sysco shares, and it is now valued at a 14% discount to historical trailing EBITDA multiples. Now, given this backdrop, we believe that Sysco will emerge as an undisputed leader coming out of this crisis. And now is the time to act.
Our first thesis point is that Sysco's scale drives its competitive advantage and reinforces barriers to entry. But why care about scale in this business? It's because customers value having distribution centers close to their locations, and the cost of distribution increases the further truckers have to drive. But what does scale even look like for Sysco? To better understand that, we have to look at the industry as a whole. Now, the US food service industry sales are concentrated in specific geographies, and Sysco serves these geographies with the most distribution centers and the largest trucking fleet, delivering a wide array of products to more than 650,000 customer locations. Economies of scale in both procurement and distribution create a sustainable competitive advantage and reinforce barriers to entry. Now, Sysco's national scale drives local advantages as well. Using FTC filings surrounding Sysco's attempted acquisition of US Foods, we were able to estimate Sysco's local market share in some of the country's largest markets. The resulting market share concentration is a higher density customer base, where unit transport costs are spread over a larger number of cases delivered. Now, this point was confirmed in our primary research, speaking with former Sysco and current competitor truck drivers, who told us that Sysco's trucks tend to have the highest average cases per truck because of its larger customer base. Now, combining Sysco's national scale in procuring goods with its local distribution scale, we can see why Sysco has continuously earned industry-leading returns, as seen both by operating profit margins and returns on capital. Our second thesis point is the massive catalyst for capacity consolidation as COVID-19 impacts force weaker distributors to exit. Sysco's scale and strong balance sheet give it the highest capacity to suffer, yet survive. Now, we've done a lot of work trying to tease out the business economics of these distributors, both small and large, scouring through offering memorandums, talking to sellers, brokers, CPAs, and other industry experts. Our primary research indicates that the small and medium-sized distributors will fold within weeks if their revenues decline by 40% or more. And that is already happening today. On the other hand, Sysco can weather the largest revenue decline for the longest period of time, withstanding a 67% decline in total revenues for up to 29 months as it rationalizes its cost basis. As the impacts of COVID-19 persist, these smaller, undercapitalized distributors will flounder, with one former Sysco executive estimating up to 33% of distributors going under, opening up 10 to 15% of the market share for the larger, better capitalized players like Sysco to capture. Now, given that accounts receivable, inventories, and accounts payable are typically on the balance sheet in equals amount, even a small increase in bad debt expense would be crushing to these smaller competitors. As a dominant player in this space, Sysco stands to be a major beneficiary as the industry consolidates, capturing additional wallet share from its current customers and new market share from washed out competitors. And Sysco has a long history of organic market share capture, taking 140 bips of share over the last 9 years. And given the COVID-19 washout, we're estimating they'll take an additional 340 bips of share over the next 5 years. Now, the market has punished Sysco as a result of COVID-19, but we believe it's created a once-in-a-lifetime opportunity to invest in Sysco as it accelerates market share capture in the United States.
Our third thesis point is that Sysco not only survives the COVID-led downturn, but emerges much stronger as weaker distributors are forced to exit the industry. Breaking down cash flows over the next 12 months, we find that if overall volumes decline by 80% for 3 months of the lockdown and 50% for the remainder of the year, Sysco still has plenty of surplus cash left over. In fact, Sysco ends up with $800 million in cash, even in a severe punitive case where Sysco has zero revenues for the next 12 months. The point being that we don't foresee any major solvency or liquidity risk with Sysco. To make matters better, Sysco's current debt is completely uncollateralized, enabling it to use its large asset base of unencumbered assets to post as collateral if need be. Now that we've established a baseline of Sysco's survival, let's turn to what our base case assumes for the industry and in turn Sysco. The total industry case volume is the blue line and the total local restaurant case volume is the green line. In the midst of restaurant lockdowns, the industry is likely to suffer a sharp downturn in volumes in the foreseeable future. We assume that total industry volumes decline 74% at trough and total local restaurant volumes decline 93% at trough. The local restaurants get hit hard. Even in a post-lockdown world, capacity restrictions and consumer reticence will lead to a long and painful recovery. To compound this problem, we note that the US was likely over-restauranted pre-COVID. This plays into our assumptions, and even at the end of our forecast period in June 2024, the industry is barely back to where it was pre-COVID. In such an environment, scale and balance sheet strength become of utmost importance. National volumes enable Sysco to cover fixed costs as the smaller distributors, completely dependent on local case volumes, flounder. Combining the volume drawdown that COVID has caused with our analysis of small distributor economics that Kyle walked through, it seems very likely to us that a large share windfall will come Sysco's way. In our base case, we assume an accelerated share capture of 340 basis points, which implies a 6% market share up for grabs for the industry, with the remainder being shared by US Foods and PFGC. Breaking down our base case further, we find that the major driver of our EBITDA growth is accelerated market share capture, which will in turn drive private label product penetration, as private label products are cheaper and are of similar quality, appealing to a cost-conscious post-COVID world. Thus, in our base case, we retain additional upside opportunities in the form of international expansion, acquisitions, and SKU rationalization.
Sorry. So given that the most critical driver is Sysco's ability to accelerate share, key assumptions in our valuation framework, which you can see in the upper left, are industry case delivery growth and Sysco's incremental share capture of those deliveries. In our upside scenario, we give 1,100 bips to the big three food service distributors, 550 bips of that goes to Sysco. In the base case, we give 700 bips to the big three and 340 bips of that goes to Sysco. In the downside case, in line with historical trends, we give 200 bips to the big three distributors and 100 bips of that to Sysco. Now applying an 11-time forward multiple, which is actually one turn less than where Sysco is trading right now, we get to 23% IRR in our base case scenario. We have negative 11% in our bear scenario and 45% in our upside scenario. Now the near-term risk is a prolonged impact from COVID-19, including changes in food away from home trends. Other more longer-term risks include competition from Amazon and regulatory and integration issues stemming from acquisitions. But based on our primary research, we believe that Sysco has the capability to mitigate all of these risks, whether because of adapting to either new industry dynamics or leveraging their existing competitive advantages. And in the interest of time, I'll leave that for the Q&A. And with that, we'll conclude our presentation. Thank you.
Who would like to go first? Sheila,
yeah, I have a question on the management. You didn't really touch on, the turnover of the management team. I mean, they had a CEO resign quite recently, but they've had a pretty significant turnover since about 2017. They've had a number of revision restatements. So can you talk to what's going on with the management team and how you're confident that there aren't any sort of hidden revision statements coming up? Thanks.
Yeah, for sure. So I'll take that question. So first of all, Tom Benet, based on our research with our primary contacts, he did not resign. He was actually let go. Now, with regards to what he was focusing on previously, he centralized a lot of Sysco's procurement. Now, Sysco, one of the biggest advantages they have is actually their purchasing power. So that does work economically. However, what that also happened is that they would lose certain white space to some of the more specialty distributors in some of the more regional areas. And so with the new CEO that was brought on, and he was actually, based on my contact, it was noted that he was actually brought on by Nelson Peltz, who's on the board. His experience is actually very, very deep in supply chain management. And when he was at CVS, he also focused on regionalizing a lot of their SKUs and category management there. And so he had a lot of success with doing that, especially in entering metro markets versus Dwan Reed. And so we believe, given that background and also given a lot of the crisis management actions that he's taken on recently, we actually have quite a lot of confidence in what he's doing. And maybe, Kyle, if you want to touch on, some of the things that he's done recently to give a little bit more color.
And also the accounting, if you could. Thanks.
Yeah, sure. Yeah, so just kind of covering a little bit about, Kevin Horkin's crisis management. I mean, just right off the bat, as soon as COVID opened up, he was very much open and out on, out on CNBC and kind of talking to the market about Sysco's strong position. Also very, very kind of had a lot of foresight on the debt raise. They went out for $4 billion, they got $4 billion, whereas we could see their competitors actually had to do an equity dilution just in the last few days, both US Foods and PFGC. Now, on the accounting side of it, obviously, we can only see so much into their books, and from what we've analyzed into the company, we don't see anywhere that is raising a lot of red flags. And through a lot of our industry contacts, when we talked about those previous revisions, they didn't raise any red flags or think it was any issues outside of the ordinary. So while certainly it's something to keep an eye on, none of our research indicates that it's something that we should be concerned about in the short term, but definitely a flag post to keep an eye on.
Yeah, just to add to the accounting issue, we actually spoke to someone on the short side, a person who was a big short on Sysco prior to COVID. And we checked the accounting issue there as well, and it came out quite clean.
You spent a lot of time about their survivability. This company's got a $28 billion market cap. It sells at 20 times earnings. Do you think anybody's worried about their survivability?
Yeah, so primarily, as we're looking at this, and obviously the market, and this was kind of came up in the short when we talked with the companies that, or the funds that were short Sysco, is that they won't have the ability to kind of weather through as all of these independent restaurants potentially either close their doors or the volume doesn't come back online quite as quickly. When you think about it, if you think in an industry where your revenues potentially decline, 60, 70% in the near term, and you have $9 billion of OpEx, liquidity is a concern. But like I said, we dug into this, and the company is able to be cash flow, like essentially cash burn neutral. They could withstand a 67% decline in their overall total revenues. And at that level, if the industry as a whole is declining at 67%, their competition, essentially the small and the medium size, they're gone in less than 2 months. And the bigger competition, US Foods and PFGC, can last about 21 months as they rationalize their cost structure.
What are your earnings per share estimates attached to your price objective? What multiple are you assuming?
So it's a 16 times multiple at exit on forward EPS.
And 16 times 2023?
2024, because we are, 2024.
16 times 2024. So what is the number you're using?
Sorry?
What is the EPS number you're using?
Sure. So the EPS number we're using is $6.
$6.23.
Yep.
And this last in 2019 was what?
292.
2019, yeah, 292.
$3. Yeah. So approximately double EPS.
So double, you're going to double earnings per share, and you're going to double the stock price. Is that what you're kind of saying? A little bit less than double the stock.
Right. Because actually multiple assumptions are, it's an 8% hit to our target price, because we're assuming lower multiples in the future.
Right.
Okay. Thank you.
Yeah. Let me see if I can get a question in.
Please, Mario.
Thank you. If we took what they deliver and called it a constant basket of goods, what happens if inflation, how's been the inflation impact? Many of the distributors I follow are able to maintain gross margin and get a lot more dollars. How does that work if the basket of goods they deliver goes up 5% as opposed to 3%? And what's it been like in the last 3 or 4 years?
Sure, I'll take that one. So bottom line on that is Sysco has a long history of being able to pass on a lot of that inflation costs. But to think about it is if inflation kicks up very rapidly in the short term, that would be a short-term hit because it takes a little while to pass that through more down to the independent non-national accounts. On the national accounts, a lot of those contracts are actually a cost plus some either fixed or percentage of cost fee. So that would pass through very quickly on the national side. But as you go down into the, into the more independent restaurants, it would take a couple of quarters to actually incrementally pass that on. And now the company has come out and said like 2% inflation is kind of like their money spot. We've modeled in only 1% inflation into the overall figures here, assuming that they will be able to continue, as they have historically, passing that on to their customers.
So we think they'll have constant margins if inflation goes from 1 to 2, more or less. With a LIFO, FIFO accounting, I don't know their accounting method.
Right. So Mario, that's what's happened historically. So historically, they break out inflation as a driver of U.S. sales, actually. So they break out, inflation has been roughly 1 to 3% over the last 5 years in that range. And so that's how, as Kyle mentioned, it's a cost plus contract with the national players and also with the independent guys, but there's some lag effect there. So it doesn't really impact margins, if that's your question.
Hey, this is John. I have 2 quick questions. Where do you think EPS is going to fall in 2020?
Right. So, John, it's slightly less intuitive to understand this company because it doesn't follow a calendar year. So it's a June ending financial year. For June ending 2020, we assume EPS is down 87%. So it's about 40 cents in our base case.
Okay. The second question is, Sysco is the largest food distributor in the U.S. with a 17% share.
Right.
That's correct.
How big are they? I guess the second biggest is U.S. Foods. What share does U.S. Foods have?
So U.S. Foods has approximately 8% share. So they're about half the size of Sysco.
So your basic theory is they're twice the size of the next largest competitor. So that gives them scale advantages, but yet they're only 17%. So over the next 4 years, due to the disruption, they should be able to consolidate their market share in the industry.
Right.
That's correct.
And what share do you think they'll get up to in 2024?
So we've estimated that they added additional 340 bips of share, so going up from the 16.9 to approximately 20.3%, assuming that essentially our assumption is that, while our research shows 10 to 15% of market share is up for grabs, we're being conservative in saying that only 6% moves from the smaller distributors to the top 3, with Sysco taking 340 bips of that.
Yeah, my only thought here is that with the, I think your 24 EPS targets could be accurate, which gives you, pretty impressive growth. But I'm worried when they report the next 2 quarter earnings and people see the sharp decline in earnings that the stock could fall and, perhaps give a better entry point. What do you think of that?
So we've certainly thought about that, and obviously, short-term market, we can't really control the short market volatility. But when we look at the long-term, kind of the sustainable competitive advantages in this business and this opportunity for them to take this share, long-term value here is what we're really keeping in mind. And if the market opens up and gives us this company, 50% lower, I'm sure I speak for the rest of our team that we'd be happy to be loading up our personal accounts.
Yep, absolutely.
Okay, let me just ask.
You were long already.
Let me squeeze in a question.
Some of us are.
Some of us are.
So let's just talk about the competitive dynamics. I mean, when you look at your financial model, if you can pull it up for a second, you're basically assuming, if I read it correctly, that the business becomes a vastly superior business over the next 5 years. Like the returns on capital almost double, if I remember.
Right.
In your model.
That's correct.
And I don't generally look at the distribution business as such a great business. And it just doesn't seem intuitive to me.
Yeah.
Let me just sort of finish the question. So that they should be allowed to earn, if you will, windfall returns, twice what they've earned historically, simply because we went through a crisis. And what I'd like you to address is sort of 2 phenomenon. One, the Amazon risk. Amazon's building the world's greatest distribution network in the world for product, for food, for everything. And they don't like someone else to be able to earn massive returns. So I think that's one. I'd like you to address that threat. And then second, interesting things are happening. Even major players, like I heard today that Heinz is actually going direct to consumer on ketchup. Like literally, you go to the Heinz website and you order ketchup as opposed to buying it from a supermarket. What is the direct to the restaurant? Again, in light of the almost commoditization of distribution, that you can buy distribution by the pound from Amazon or others. why do we need something as old-fashioned as a food distributor, and why should they be able to earn windfall returns?
Yeah, so I can take that question. So
and you have 30 seconds to answer.
So Amazon's distribution centers, if you see on the chart, they're all the way, they're the little guy on the right. And their distribution center is specifically focused on groceries, which is completely different from the scale and the warehouse slots that are needed for industrial sized, restaurant businesses. And so those distribution centers, like even though they have 4 million of square footage there, that effectively is nothing. And they'll need to build that out completely to be able to match Sysco scale. And so if they want to do that, it's about $45 million to $60 million per distribution center. And the payback period on each one of those, if we assume that up front, they start earning the same margins as US Foods, it's going to take them about 10 to 12 years. And US Foods is the second best player in this space. And they'll have to do that with 170 locations in the US, and that's going to cost them about like $8.5 to $11 billion, depending on the locations that they choose. And I'm sorry, so Bill, you also had a second question. I think it was related to.
Why don't we pause there? And
yeah.
We're over time by a little bit, and just want to thank you guys for an excellent presentation.
Thank you so much, Bill.
And I think we have one more. Is that right?
Yep, one more. Last up is Veris Analytics. Okay, guys, whenever you're ready.
Good evening, everyone. My name is Ruth Chen, and I'm here with my teammates Yi Chang and Mark Hu to recommend Veris. So we recommend Veris Analytics as a compelling long with 15% IRR in the next 3 years because of pricing power due to dominant and sustainable moat, large and growing TAM with potential to cross-sell, and stabilization in the energy segment. Veris has shown consistent and strong growth, and with the recent sell-off in the market, we think it's a great opportunity to invest in a high-quality company. The street underestimates Veris' competitive data advantage, leading to a difference in top-line growth estimates. We estimate top-line growth to be 9% versus consensus of 7%. So Veris is a mission-critical data analytics solution to the insurance, energy, and financial industries. 71% of the revenue comes from the insurance business, where they can use predictive modeling to help insurers calculate the expected loss expense for the policy written and determine the appropriate price to charge. The company collects and aggregates premiums and claims data from insurance companies, and they've built out this database for over 47 years. In the energy segment, which comprises 22% of revenue, Veris' primary product is the Wood Mackenzie subscription platform. Wood Mackenzie is used by energy companies for financial planning and CapEx decisions, and by financial service customers for due diligence and investment decisions. What sets Veris apart is that the company has amassed a large collection of unique and defensible data sets, with their data set at least 2 times that of any competitor. 80% of their revenue comes from subscription contracts that are usually 3 to 5 years long, and customers are also very sticky with a retention rate of at least 95%, all of which contributes to an organic growth rate of 7%. Many of Veris' customers are the top businesses in their respective industries, and Veris will benefit from the increasing global trend of customers spending more on data analytics.
So for the first part of our investment thesis, in its core segment, insurance, Veris has built out a dominant, sustainable economic moat that leads to significant pricing power. The company has a clear value proposition to its customers. In insurance, the industry is highly fragmented, with the top P&C insurer in the US, State Farm, representing less than 10% of the market and a long tail of over 2,500 smaller insurers. For each individual insurer, they only have data on customers in their book, and basing their pricing on this can lead to significant overpricing or underpricing of risk. Veris has the most comprehensive database in the industry, capturing over 90% of US P&C premiums. As a comparison of their scale, the company added 4.4 billion transactions, both claims and premiums, in 2019, while Allstate, the 5th largest insurance company, wrote fewer than 32 million policies. For another example of Veris' scale, we can take a look at auto claims. The company is able to calculate expected loss expense by make and model of car for over 220,000 census block groups across the United States. That level of data granularity is something that individual insurers simply cannot match. Accurately calculating loss expense is crucial for insurance companies. We can see here that there's a significant negative correlation between loss ratio and insurers' profitability as measured by return on equity. Veris' comprehensive database allows insurers to calculate loss expense and set prices, which drives a meaningful value proposition. Veris' economic moat is defended by a combination of network effects, minimum efficient scale, and regulation. First, the company has significantly more data than any other competitor. The second largest competitor is a nonprofit rating bureau called AAIS that has significantly less data. And from the primary research calls we did with Veris insurer and reinsurer customers, we understand that large insurers prefer to work with a player of scale like Veris because they have diverse exposures across different geographies and across different insurance lines. Second, the cost of an insurer building out a database in-house is extremely high. Veris testified in front of the US Senate that the cost of calculating loss expense for just one line of insurance is approximately $14.6 million in 2020 dollars. That does not include the cost of acquiring the data. So for most insurers, it is very time-consuming, difficult, and expensive for them to bring this in-house and build out a database to rival Veris in-house versus paying for the company's services. Third, insurance is an industry that is regulated by state, and any national competitor to Veris would need to be first certified in all 50 states before being able to offer its services to the largest insurers. This, in our mind, creates a significant barrier to entry. We believe that Veris provides a mission-critical product to insurers at a low cost, less than 2% of an insurer's operating expenses. So we see the opportunity for the company to leverage this economic moat to drive secular top-line growth for longer than the market expects. Price increases account for about half of our forecasted insurance revenue growth of 10% versus consensus of 6%.
Our second thesis, cross-selling in the growing TAM, accounts for the other 50% of our insurance revenue growth. Veris insurance TAM has grown by 6% annually to $9 billion in 2018, driven by 14 tuck-in acquisitions and increasing customer spend on data analytics. According to a former sales rep, Veris pulls data from acquisitions and presents them in ways that are more embedded into customer workflows. Our Crunchbase analysis shows a robust universe of over 300 potential acquisition targets, giving us confidence that the TAM will continue to expand through M&As. In addition, recent management comments from large insurers suggest increasing spend on data analytics, which also bodes well for TAM expansion. Veris has 20% market share and is competing against other third-party data vendors who have 30% share, as well as insurers' internal data analytics. Veris has been able to get more products adopted by customers, as shown in the bottom left chart here. Based on our primary research, well before contracts up for renewal, the sales team would actively look at what additional products they can sell. The company has successfully converted customers given a high win rate of 50 to 80% on new customers, while maintaining existing customers with a low churn rate of 3 to 8%. As a result, we think Veris is well positioned to gain share. From the insurance premiums perspective, Veris has a large size of wallet of over $1 trillion of insurance premiums growing above GDP. Its share of wallets measured by revenue as a percentage of premiums written has grown on average by 1 bps a year. To conclude, we forecast 10% insurance revenue growth versus 6% consensus. We believe Veris' core insurance business can continue to gain share in the growing TAM through cross-selling. Our third thesis is that concerns for the energy segment are overblown. Veris' energy segment consists of Wood Mackenzie, Power Advocate, and Genscape. The business is very sticky. 70% of its revenues come from subscriptions with 90% plus customer retention. Based on primary research, the core Wood Mackenzie business is well embedded into customers' planning process. In addition, despite the cyclical nature of the industry, Veris' energy business has grown in historical down cycles. During the last energy downturn in 2016 and 17, customer capex declined 41%, and oil prices declined 52% from peak to trough. However, Wood Mackenzie still managed to grow organic revenue by low single digits on a constant currency basis. This is due to the mission-critical nature of the business and diversification of its customer base.
Lastly, the Genscape acquisition in 2019 gave Veris a large base of new and sticky customers. Genscape uses sensors to collect real-time data on the flows of physical commodities. Based on our primary research, Genscape is essential for commodity trading firms and hedge funds to successfully compete in the market. The acquisition enlarged Veris Energy customer base from 700 to over 2,000.
So Veris currently trades at 21 times EV to EBITDA multiple, which is above its information services comps of 17 times. However, we believe Veris is a fundamentally better business that merits its premium multiple. First, Veris operates in an attractive and less cyclical end market and offers a unique value proposition to drive stable organic growth through different economic cycles. Second, Veris' industry-leading margins are sustainable because of its proprietary data that creates high barriers to entry. While the company trades at a high valuation relative to historical level, improved fundamentals in the insurance end market should be a tailwind for Veris to continue driving price increases and cross-sell. So our target price of $222 is based on 21 times our 2023 EBITDA estimate of $1.83 billion. From our analysis and research, we believe the span of outcomes is highly attractive. And we're happy to go into risk and mitigants during Q&A, but to conclude, for this research, we've conducted over 30 calls to understand the business model, the pricing power, ability to cross-sell, and outlook on the energy business. Thank you for your time, and we welcome any questions.
This is Lee Cooperman. Can I ask you, I should have asked this to everybody, but I didn't. How did you arrive at picking Veris as your idea to pitch? What was the process you went through to determine this was the best looking, security out there?
Sure. So the theme for this year's presentation was a non-activist team, and we picked this before the COVID-19 situation. I would say that there are three criteria that we looked for that made us decide to choose Veris. First is that we thought that this was a very high quality, less cyclical business that had an extraordinary and sustainable dominant moat. The second reason is we saw that there was an opportunity for secular long-term growth through both price increases, through cross-selling, and through M&A. And the third reason is that we saw that the market had a different view regarding the energy segment, as well as what they can achieve through M&A within the insurance segment. And that's why we decided to do more work on this business.
You talked about enterprise value, EBITDA. A very smart man who's deceased told me EBITDA stands for we have no earnings. What is the conventional multiple you're assuming in 2024 to get to your price objective?
So, the reason why we decided to use EV to EBITDA multiple specifically was because management is actually incentivized on EBITDA growth. And then the multiple that we're assuming is actually 21 times in 2022.
Actually, to ask further on Lee's question, because I had the same question, a lot of information technology type or data businesses compensate their management teams with large amounts of equity grants, which have economic costs but don't appear in the EBITDA valuation. Can you tell us where is it trading relative to earnings, kind of next year and on kind of GAAP earnings basis? And why is that a fair price or an attractive price?
So we looked at it on a kind of three multiples. So for EBITDA right now, we would assume 21. And then when we looked at, we also looked at a price free cash flow basis, and currently it's at about 28. And when we did a discounted cash flow analysis, our 2022 exit multiple showed that our multiple would actually be basically one turn above what it's trading now. And then on a price to earnings multiple, it's currently at about forward multiple is about 36. And then again, based on our EPS estimate in 2023, the multiple would actually still hold to be about 36.
Okay.
And you're assuming a 36 multiple on your price objective. Is that what you said?
We're not, so it's basically, we're assuming 21 on our EBITDA. And then when we did the analysis for other multiples, we found that they're actually going to stay consistent with what they are today.
Okay.
I'm not maybe understanding it. What is the multiple of GAAP earnings?
I think she said 36. Let me get to Jillian's question. Jillian, go ahead.
That's what you said.
Thanks. So the company's been very highly acquisitive, right? So they've bought like something like 20 companies in the last couple of years. So can you talk to the underlying growth and what's the desire to be so acquisitive?
Sure, I can take that. So management made a lot of acquisition over the past few years, and primarily, most of the acquisitions are smaller tuck-in acquisitions within insurance. And the larger acquisition management did were Power Advocate in 2017, Sequel in 2017, and Genscape in 2019. And the main objectives for doing acquisitions are to acquire new and proprietary data sets. I think we have a slide, slide 38. The main objectives are to acquire new and proprietary data sets and enlarge the customer base and be able to cross-sell additional products to more customers. And so we have a slide 36. So that gives you two examples of M&As they did in the past. We think eventually in the long term, those acquisitions make strategic sense and they should help the company grow its ROIC. So the first example here is the AIR business the company acquired back in 2002. So AIR provides a set of models to help insurers understand the risk, catastrophe risk, such as hurricanes or earthquakes. And Veris was able to integrate CAT risk from the AIR business with non-CAT risk from its core ISO business onto the same platform that's well embedded into customer workflows. And the ROIC for this acquisition went from 15% in 2005 to 31% in 2017, representing a 6% CAGR in operating income. And another example here is the Exactware business. It's acquired in 2006. And similar to the AIR business, the acquisition increased the usability of various products, and the ROIC went from 12% in 2009 to 27% in 2017, representing an 11% CAGR in operating income. So to summarize, we think the acquisitions do make strategic sense for the company. They should help grow the ROIC in the long term. And the rationale is really to acquire new data sets in large customer base and be able to cross-sell more products to more customers.
Anna, would you like to ask a question? You've been a little bit quiet.
Sure, I have two questions. The first question is, what percent of receivables are from the energy segment? And the second question is, you guys are modeling pricing 5 to 6% annually, which is 2 times what consensus is assuming. What is that based on, especially considering potential risk from energy?
Sure. So just to clarify on your question, Anna, when you talk about the 5% pricing, are you talking about are you asking what we're assuming in price increases on the energy segment or for the overall business?
You were assuming 5 to 6% across the board on one of your slides. And
yeah.
Below it,
okay.
you said it was 3 to 4 or 2 to 3.
Got it. Got it. So I'll address those two questions in order. So the first question around the energy business. So energy represents 22% of the company's overall revenues. And the way that we think about the business is it's primarily a research subscription business. And so it's generally annual contracts. The renewal rates for that business has been over 95%. And so we don't see a significant amount of receivables risk for that part of the business. In terms of the revenue growth, we believe that the organic 5% price increases are coming primarily from the insurance segment. And how we got comfortable with that was we conducted different VAR calls with some of their customers on the insurer and reinsurer side to assess what the typical price increase is. We looked at if they were to increase prices at 5% over a course of 20 years, what would be the impact on an insurer's margins, something like 30 basis points to get comfortable with the price increases. Within the energy segment, we are not assuming 5% price increases. That we're primarily assuming on the energy side that's driving the organic growth is mainly a combination of them cross-selling products from that they've acquired through the acquisition of Power Advocate and Genscape to the legacy Wood Mackenzie customer base.
Okay, thank you.
It's Anthony. I have a question. What was their pricing like historically? Have they always done 5-6% price increases, or is that a big change in strategy versus what they've done over the last 10 or 20 years on average?
Sure. So the interesting thing about this company is that it started off previously as a nonprofit organization. It started off as a consolidation of several rating bureaus, and it was actually a nonprofit. Since the company went public in the 2000s, it recognized the need to become more profitable, and it started pushing through more of these price increases. So it's more of a recent phenomenon. The way that we thought about whether these are sustainable or not was looking at the value they provide relative to the cost. So currently, the Veris costs represent about 200 basis points of an insurer's operating expenses. So it's not a material expense for them on operating side. But in terms of the value they provide, loss ratio is so important for the insurers because it directly impacts profitability. And so we did some analysis here on this slide as well to show that this is something that we believe is sustainable over the longer term.
Do you know what their price increases have been on average over the last 5 years, let's say?
So the company does not specifically report the price increases. So the triangulation that we've done when we talked to their customers has been that people generally grow prices always in excess of inflation, and a 5% price increases is typically seen in the industry.
So if I could follow up really on a line of questioning that led by Lee Cooperman, and I'm being super straightforward. So I think you've made an excellent presentation in terms of describing the company, the sort of industry positioning, the opportunity in the business. Where I think you haven't yet convinced me is on valuation. And I don't, an EBITDA valuation doesn't make sense to me. You know, why are GAAP earnings not the right way to think about the business? And why is a 36 multiple an appropriate multiple for the business? If you could help us justify that multiple valuation on the basis of the GAAP earnings the business are going to generate. I mean, is there something understated about the company's GAAP earnings that's not the right way to think about the business? Or is that, you know, help us understand why this valuation is a fair valuation?
I think, well, one thing, if we just compare on a peer basis, it's actually, we just see that it's a much higher quality and less cyclical business, and that's why it deserves this premium over it. And there's 3 reasons why we think why it's a higher quality. There's more stable and secular organic revenue growth, it's high and sustainable profitability, and there's strong ROIC that can improve over time. We saw that throughout the global financial crisis, was able to drive positive organic revenue growth specifically because insurance profitability is driven more by occurrence of extreme events rather than macroeconomic conditions. And then given Veris value proposition and its business model of 3 to 5 year contracts, they have a higher growth rate than peers. And we think that this growth rate is actually going to continue. Second, Veris has a really, really high profitability compared to its peers. And this is because most of the data, again, is proprietary. And when you're proprietary, there's high barriers to entry and there's going to be low competition, which allows Veris to sustain their margins. And then back on the point of ROIC, their return on invested capital has been high relative to peers. And we think that the company, as they continue to drive top line growth through price increases and cross-selling, we do expect their ROIC to improve due to the significant operating leverage that the company has on its fixed personnel and employee base. And so just for these reasons, we think that's why Veris actually deserves that multiple right now and it's a premium valuation because it's a specifically much higher quality company.
Okay, great, thank you. So that's the end of the presentation. That was an excellent presentation. The judges, we're going to go to another room. For those of us who are not familiar with how to do that, can someone from Columbia help us? Julia, someone help us get there.
Bill, you're on.
Okay, so we had, as you would expect, a very spirited discussion in the judging room. I think there was a strong collective view that there were 5 outstanding presentations, and we had a lot of debate with a goal of picking a first place and a second place. And it was a tough call. And in fact, for the first time in the history of the Pershing Square Challenge for 13 years, there was actually a tie for first and second place in terms of how people voted. And that Lee Cooperman offered to me the opportunity to pick the first versus the second prize because we're putting up the prize money. And I offered him the opportunity, if he wanted to put up $50,000 or more so that he could rebalance the prizes and pick his winner. He said 40 million is enough. So they let the development department know that Lee is tapped out in terms of Columbia University giving. I couldn't get $50,000 out of the guy at the last hour. But in all seriousness, let's go first to the winner, and then we'll go to Or should we go to the second? We'll go to second, and then we'll tell you who the winner is. So in second place, we chose Sysco. And the kind of collective view was, one, it was an excellent presentation. Two, we thought a value opportunity with significant upside. We thought there was a credible case made for the company winning share post crisis. But ultimately, we chose it second. And we chose it second because we felt that there was an opportunity to do a better job. We felt that, I guess I felt that, at least in my case, that almost a double in returns were not likely in light of the fact that while there was a likelihood they would take share, on the other side, we also believed that restaurants would become more concentrated to stronger owners, and there would be some pushback on pricing. And then we felt that the Amazon risk was a real risk, and that simply a $10 or $11 billion investment in a longer payback period wasn't sufficient to scare Amazon from a market where we felt that they could fairly quickly be a threat, and that would temper the returns. But a very strong result and a $50,000 prize to the folks at Sysco. So now, in terms of picking the winner, a lot of debate here. And ultimately, we chose EPAM. And I think collectively, everyone felt that it was an outstanding presentation, that the team did a superb job in addressing challenging questions, and that while we really had difficulty, we felt that just the valuation was sensible. The fact that you chose a lower exit multiple. You made a reasonably credible case for the the continued growth of the business, the way discussions about continuity among key customers and how they've been able to win different parts of the Expedia opportunity, etc. I think the group consistently believed it was a strong idea. So I would say it was. I think we're lean more towards Sysco because he's a value guy, doesn't like to buy stocks with too big a multiple. I leaned more toward EPAM because I thought that the team did on the margin, a better job in addressing, a tough set of questions. In terms of other ideas, we thought Veris made it, it's really an excellent presentation. We felt there was an opportunity missed on explaining and justifying a valuation purely on an EBITDA basis and just purely on a comparable basis. On Ball, we felt, very good discussion of the industry and the changes in the company. We were, quite impressed, but felt, pretty high valuation for a business that ultimately we didn't feel that what they did was particularly proprietary and could be threatened by competitors. And on Broadridge, the concern, again, of a very large market share monopolist operating with, mainframe-based technology, and where it would move from paper to digital for a very big part of their business. We felt that the risk of technology disruption, and we didn't feel the team adequately discussed that threat. But again, a lot of people in the group initially had Broadridge pretty high, but as we discussed more of the technology disruption risk, it dropped off the list. But just want to convey from everyone, including your toughest questioners, that everyone felt the presentations were all outstanding. We were forced to pick a number one and a number two, but congratulations, really everyone for making the finals, and to the EPAM and Sysco teams for winning. Normally this is the time to take photos, we put our arms around one another, and we smile for the cameras with all the judges. But would any of the other judges like to make a statement? Is that Mario?
No, that's Lee.
Lee, we can't hear Lee.
Lee is not happy that he's.
Why can't we hear him?
I know. Unfortunately, he says that he's happy that he's not their age because he didn't want to compete with them. Much smarter than both of us.
So evolution is continuing. The next generation is going to be better than the old generation, and that's a wonderful thing for us to hear. Anyway, look, we're past our deadline. It's almost 9 o'clock. We were supposed to finish closer to 8:15. I just want to thank the Columbia team, Meredith, and all of the judges for taking, their evening when they could be going out in the town, going to theater or whatever, concerts, other things they had, Yes, in all seriousness, thank you to everyone for participating. Another great year, a super impressive group of students. Columbia Business School has done a great job, and we leave it up to the students to decide what to do with their prizes, and we look forward to hearing what they decide.